Welcome to another episode of MyArtBroker Talks. I'm your host, Charlotte Stewart. In the ever-evolving landscape of the art market, the concept of art as an asset class is often met with skepticism by traditional art enthusiasts. Today, we sit down with Harco van der Oever, CEO of Overstone, to discuss an area that is very much at the centre of their mission. Welcome, Harco. Today, we're going to be talking a lot about art and data science and finance and the intersection of those. And previously, we've had some brilliant guests on talking about art and technology and the efficiencies that we can make in this marketplace. A lot of traditional art businesses feel that the concept of art as an asset, they're quite uncomfortable with. What I'm particularly interested about is discussing how Overstone approaches this as it's the core of the mission in many ways. Perhaps you could start with telling us where the idea of Overstone came from, what problem it solved and for who.
Yeah, no, absolutely. So I'm originally an investment banker. So I started my career in debt capital markets, spent about 12 years in debt capital markets. So very much looking at debt transactions, loans, etc. I then had a stint as an entrepreneur doing a building UK's first online mortgage brokerage platform. So still very much in that debt space, but now bringing in technology. And then when I sold that business, I did something completely different, which was to join Christie's and spent about 12 years in various roles, most recently as head of continental Europe. And then I became global head of the Impressionist and Modern Art department. And doing that, I had a lot to do with our top clients and particularly negotiating consignments with our top clients. And most of those negotiations involved some kind of a financial deal, be it a guarantee, an advance, loans, etc. That our client base was very sophisticated financially, right? A lot of private equity people, a lot of venture capitalists, and so that's really why I left Christie's to found Overstone, with the view to bring in a structure to the assessment of art as collateral. Really, that was all, right? And so. One of the key concepts behind what we're doing is the fact that if you bring in structure into an inefficient markets, what happens then is that you start attracting institutional clients, institutional participations in that market. The more institutions you bring to that market, the more that market structure, and the more it attracts more institutions, and you start creating velocity in that space, and you start creating volume. And when you think about the size of the art secured lending market compared to the overall value of art in private hands, and you compare that to any other asset class, be it real estate, be it yachts, be it jets, be it cars, it's minute. And it's my deep belief that the reason for that is that lack of structure and a lack of tools to enable those institutions to participate. So when we started working with our big institutional clients, one of the things that was very clear was that they found it very difficult to measure the risk of works of art, understand the metrics around that, and therefore, how does a risk department for a bank calculate the amount of capital that they have to put aside for these transactions? And so that's really what drove us in looking for data solutions.
Mm-hmm. What the area of the market that I'm more familiar with, and this is because we work in the prints market, people who are looking to release £60,000 against a £200,000 Liechtenstein print. Yeah. That area of the market is an area full of challenges, because that particular print could be worth £200,000 in 1 year, and then very quickly, if the market was to change, it could be worth a lot less, and yet they've lent against it. I presume your business doesn't look at things of that value, or is it useful for somebody who's looking to lend against a £200,000 artwork?
Yeah, listen, when we started with the biggest global private banks, right? And the average lot value of a collateral that we did in the first 4 or 5 years was around $1 million average, right? So much bigger values. But the data that we have accumulated and the data analytics start at around $30,000. So we won't look at anything underneath that, but $30,000 and above. And that's where, for institutions, you get the biggest bang for your buck, be it for the banks, but also for our insurance clients, which is another part of our business.
And so you're employed by the institution and not by the private client, the owner of that particular collection. And just because obviously you're a regulated, financially regulated company, which is, something quite unusual in the art.
So when we started working with the institutions, it was very clear to us that we needed to have an infrastructure that was at par with theirs. Right? We needed to give them the confidence that we weren't just a small little outfit, but that actually we had the oversight of both the FCA, but also the Information Commissioner's Office, where, so anything that has to do with how we handle data, GDPR questions, anything that has to do with data security. So we're accredited ISO 27001, which is the hardest certification you can get when it comes to data security and how you handle data. So that is really important for us to not only to ensure that the data and how we handle with our clients is robust, but also to give them that confidence. And actually what happens then is that when we get onboarded by a major global institution, be it a bank or an insurance underwriter, a lot of the questions that they ask as an onboarding process are already answered because of the fact that we're regulated, because of the fact that we're ISO 27001 certified, because we're members of the ICO, right? All of these different elements help us now in streamlining that process, onboarding process. Yeah. But it's cool. There's no doubt, yeah.
We'll get into perhaps more of the intricacies of how the actual data science and the technology works in order to get you to the level of financial regulation. But what were the challenges that you faced when you went about creating a financially regulated, essentially art valuation business? Because art is not a science. You may argue it is a science, and tell me how it works to get to the level of security and trust that you need to in order to function.
Yeah. So I think the way we look at it is that you have a continuum in the assessment of art that goes from it's purely human experience and human expertise, and at the other end of the continuum, it's purely data driven, right? And you have businesses that are along that continuum, right? There's businesses that portray themselves as being totally data-driven, where they value works of art using purely AI. And then you have companies that are just purely, art advisory firms that just look at the expertise of their team. We believe that the truth and the efficiency sits somewhere in that continuum. Now, what is interesting is that where you sit within that continuum completely depends on the artist, depends on the work of art. You may have an artist that is highly prolific or was highly prolific and that has a very homogeneous body of work. If that is the case, then you can be very much towards the data end of that continuum, right? You have other artists, like a young artist just coming to the market. They're 20 years old. That the data doesn't really help you there, and so there you're very much looking at the human expertise to assess the risk and the value. So what we do is we're trying to push the needle more and more towards data, because we believe that creates a way that is robust, that is repeatable, and where the answer is always the same every time you ask the model. But realizing that actually you'll never get to a point where you have 100% data-driven assessment of works of art, right? And so that's really what the challenge is how do you push that data as far as possible without losing, right, the importance of the human experience when facing a work of art and the expertise about a particular market.
That's exactly on a perhaps a smaller, more niche scale what we do at MyArtBroker. So our algorithm is based on about 40 different factors that impact value.
Yeah.
But we only use, we're lucky, we've got additions. So we've got several data points. There might be a series of 600. But then, and also we always look at things that have been in the secondary market. So, you're talking about primary market, incredible artist, straight out of a major Gagosian show. How can you tell the value of that, in the future to come? Whereas we've got, years of data behind us for a Warhol or a Hockney. But what we do is we then use 40 data points that we think affect value. So that might be number of unsold versions of that print that's gone through. That might be interest in the other colorway within the same portfolio or series. That could be artist trend, topical elements. But again, we are very, we've got 40 and we're in the prints market, so which is a relatively easy recipe. It's very easy, actually. It's very similar to, wine or watches or cars. These are all additions. What if I can come up with 40, or my incredibly brilliant, and not me, data team can come up with 40? How many factors and what things do you take into account on the data side of the spectrum in order to come up with something which leans heavily on the data? So let's put the primary piece aside, because we too daily have an archivist and specialist working on that data, keeping it fresh after every public sale or every private sale through us. But where did you start when you went, right? Did you start with auction data? Was that the beginning?
Yeah. So what we did is the first thing is, I'm not a data scientist, right? So I needed to find someone who was going to be able to help me understand the impact of data on, particularly what I was interested in was the liquidity of works of art. Because when you're taking risk on a work of art, be it as a lender or as an insurer, really the primary risk is it's not so much price fluctuation. It's is this object going to sell or not? So that's really what we started off with, is how do we understand really what you would call market depth for a particular object, taking into consideration these variables, right? We don't quite have 40, and I'd be very interested to have a conversation with you after this to understand, which are those that maybe we can also lean on. But the point was very much on the onset is figuring out, okay, so how do we measure liquidity? We partnered then with Professor Spanias, who was at the time teaching at HEC, and who's, in my view, the foremost academic in the understanding of data on works of art. So he's an economics professor. And so with him, we've developed a set of algorithms that enable us to understand liquidity, understand what that market depth is. What is interesting then is that how do you then use that metric to understand the dynamic impact that has on a particular work of art? So as you were very rightly saying, market evolves, the market is dynamic, and the appetite for particular objects at given prices changes. And so that's really what we look at. So we're very narrow and very focused on the tool. So it's a very, at the core, it's pretty simple. What is the likelihood that a particular object is going to sell at a particular price? Mm-hmm. But we're now on our fourth generation of the same algorithm. We're now using a Bayesian model, right? It's much more sophisticated than when we started 6-7 years ago. Mm. But ultimately, the output is the same, right? Is given a probability, and then looking at how that probability evolves over time. So you start with auction data, but then obviously you build your own data sets, right? So we've been doing this again for 6-7 years, and so we have a vast in-house proprietary data set that also informs our assessment of those goals.
Mm. And where do you get that data from? Do you work closely with enough dealers and auction houses and galleries in order to?
Yeah. So it's a combination, right? It's a combination of our own access to what's available online, right? We work with third-party data providers. Mm-hmm. Whom we buy data, and the reason is we do that is that we then triangulate what we get ourselves, what we get from third parties, so that we can immediately see, okay, where there's particular issues. Because as you know, right, coming from a data company yourself, is that the challenge is not so much the algorithm itself, although obviously the sophistication of that is critical, and the accuracy of that is critical. But the challenge is really the quality of the data that goes into it.
Yeah.
So I would say that if I look at my data team, I would say that probably 70% of their time goes into structuring data and ensuring that that data is correct.
Mm-hmm.
Right? That it tells us what it should be telling us, and that's the hardest bit.
Yeah, quality in, quality out. I think it's, again, just in parallel, the prints market is particularly difficult in that regard, because things are catalogued incorrectly. They're probably not worth perhaps as much as some of the data that you're drawing on. So things, you can't have a load of Sunday B morning Warhol prints go into your Warhol data, because it skews everything. And then we also have all sorts of other issues where we have a lot of celebrity provenance sales, which will drag prices up.
So for us, one of the principles around the structuring of the data science and the algorithms that we built is that they have to be transparent, right? We need to be able to look in under the hood to see exactly what's going on, because when you start interpreting that information, you need to understand what are the drivers that give us a particular result. So when we have our valuations team, our team of art experts, look at the value of a work of art, leaning heavily in some cases, right? Again, depends where you are on that continuum on the data. It's really important that they understand what is driving that data. Is it the size that's driving it? Is it the subject matter that's driving it? Is it the dominant color that's driving it, right? And so for us, that transparency of the model has always been really, really important.
Mm. That's really interesting that I'm not sure how many people would assume that things like dominant color or subject matter perhaps subject matter. Funnily enough, there are themes within the print market that are, there are themes around color, and there are certainly subject matter. We talk about wall appeal, but most of these things, and also size. I sometimes feel terribly sad about the fact that size has such an impact on the value of art, because it's so basic. But it does, and that can work both ways. It's quite difficult to place an enormous set of prints, whereas it's relatively easy to place one that's about the size of above somebody's mantle, and so those works are always popular. However, with prints, because there are so many financial data points, those sorts of things come out in the results anyway. It's really about supply and demand in our market, because everything's moving all the time. Can I ask I think it's really interesting that you built this over 6 or 7 years, because obviously, I'm sure you could say this in any sprint of 6 or 7 years, but things change dramatically in terms of technology and data science. And we've only built our algorithm in the last 2-3 years. And things have changed, the efficiencies have changed. Dare I ask if AI is on your roadmap for the future and how you'll use it?
Yeah, well, AI. Well, define AI, right? So data science, in a sense, is AI, right? But I think what's more interesting is large language models, right? And can we use large language models to create more efficiency and more accuracy in the model? The jury's still out, so we're very much looking into that. We're looking at large language models, particularly in the data structuring side, actually. And we're looking at large language models in how do we extract information from the data that we're getting. So one of the big challenges that we face is that when we work with some of our clients, and this is more true on the insurance side, we get fairly substantial data dumps on from what they are insuring, or it's the same with the banks, I guess. But the challenge there is, that data is structured in all different kind of formats. You've seen it, right? You have, even the value, it says, GBP 5,000. Now, GBP, you need to extract that out of the cell and then extract the 5,000. Seems super simple, but is actually ultimately quite hard to do. And we've seen that large language models can really streamline that. And so we're starting to look at the implications of large language models onto the data science. Is it going to help us today to get better understanding of liquidity and value? Maybe, not sure yet. But again, we're very closely looking at that and looking at the tools. And the great thing is that a lot of these tools are readily available, right? And so so we can actually test these things out.
I think it's really interesting because it's exactly the same here with our use of AI at the moment is very much about data structuring before it, I always talk with AI about the sandwich effect, which is, the first piece of bread needs to have a huge amount of human interaction and quality assurance. Then you use the AI, then you put the other piece on the top, and then when it comes out, you check it and you make sure it's a good sandwich, because otherwise, you very quickly out of control of your data. Harvesting data and organizing data. Again, we're quite lucky in the prints market. It's relatively, we're not dealing with sculptures or tapestries or old masters, so it's relatively easy for us to format things. But exactly like that, when you're harvesting an awful lot of data, and that is what the prints market needed, because so it's not about looking at the 4 top auction houses and going, which is actually what happens. People look at the 4 auction houses and what they're selling, what went through the last sale, and if that was in bad condition and the value was, 20% lower than it should be, that will actually affect the next time somebody bids. Where in reality, about 15 of those works have gone for sale around the world, but nobody's looking at those data points. So there's a lot of parallels in the way that we approach the data.
So Charlotte, are you when you're using data on the prints, what's the aim for what is the output of your algorithm?
The output of our algorithm is something called what we call a value indicator. So it's not an auction estimate. It is a from and to figure that the algorithm outputs against almost every blue chip print or edition in the marketplace for contemporary and modern. We don't sell that data. We use that data for our clients. So it's just a value we give them, and then what's great about it is there's a product called My Portfolio where they can put all their prints into their digital wallet, and the algorithm will update in real time as sales happen, as offers come in, as demand peaks within the private network as well as the public. Again, it's just prints and multiples. It's very easy to do if you're doing it. Well, it's a lot easier to do if you're doing it in a very niche marketplace. And, we've been in the market for 15 years, so we've got private sales data and private valuations over a 15-year period. I'm interested to understand a little bit more about the need in the market for this, because my experience with, we provide a lot of insurance valuations for clients, which tends to be, relatively easy for us from a replacement value perspective. And also something that prints collectors particularly need to keep up to date with because of the liquidity and the move of the market. I mean, the Banksy market, for instance, Banksy print market, you could be insuring a girl with balloon for far too much now if you insured it when the market was at its peak. So, it's relatively large amounts of money that you can save by knowing how much value, and also large amounts of money you can lose if you have got something incorrectly insured. My experience of certain parts of the insurance market is that the client approaches the insurer with a price they would like to insure something at. So if they have bought an artwork that is, I will go to my insurer and say, I've bought an artwork, it was £400,000. I bought it from a gallery for £400,000. So I would like to insure it for £500,000 because I'm expecting it to go up.
Yeah.
And then, but the reality is that artwork is not worth anywhere near £400,000 because it was bought from a retail gallery where it was actually, hiked by 50%. There's not a particular incentive for the insurer to, at that level anyway, in my experience, to really know the value of that artwork. They tend to just go with what they're told by the client.
Yeah.
Do you agree with that? And therefore, I can understand from a lending perspective, it's incredibly important for them to understand the risk that they're taking on. How does it work with insurance? What problem is that solving for the insurers or the underwriters with your product?
Yeah, so what you're going to realize is that, again, we are at quite a different value scale, right, what we do. So the impact between 500 pounds or 1,000 or even 50,000 pounds versus 100,000 pounds is for a large insurance underwriter is not massive. And if it limits, so one of the challenges that underwriters have and brokers have is the friction that valuation brings with it, right? And so what we're finding is that you have a balance between trying to limit the friction of doing revaluations, but also looking at the impact that changes in values have over time. So where the market is at the moment is that you may have agreed values. So that what you were talking about earlier. So agreed values is a basis is very straightforward. We agree that it's worth £500,000. Period. Right? If something happens to it. Now, in case of a loss, that sometimes brings in some challenges because a loss is not necessarily 100% of the work. So you start getting friction in how you interact with the loss adjuster. When you're looking at very high value works of art, that delta becomes much bigger, right? And then if I have a work that was valued 5 years ago and I'm still insuring it, and as a client I believe that it's probably still worth the same, because I don't want to have Sotheby's or Christie's or any of the other auction houses come and revalue my entire collection, you actually may find that that value may have gone up by 10, 15, 20%. But if your collection is worth $500 million, that 10%, even if that's on 10% of the work, so 20% of the work, is a big, big number, right? And you know what happens, right? Is when something goes wrong, it usually goes pretty badly wrong, right? And so it's quite binary. And so what we find, and that's where we are, right? Is in that space where the differences are material, and so that's what that's the clients we deal with, right? And those are the types of interactions. And that when you're looking at the service we offer, it's not just data science. It's a combination. It's an end-to-end service to help our clients navigate art as an asset. And it's not about art as an asset. It's an asset. Therefore, I'm just going to trade it as an asset. It's not about that, right? It's helping the industry, be it lenders, be it insurers, be it wealth managers, consider it and monitor it and manage it in the same way you would other assets. And that's to everyone's benefit, right? And it's not a question of, does that take away from the beauty or from the emotional value of works of art? No, absolutely not. Quite the contrary, right? It enables you to buy works of art with more confidence.
Yeah, it absolutely. That's exactly what it does. And I think it's always been quite a difficult conversation with the finance world. I mean, you're a classic example of someone who has lived in both and therefore can bridge that gap. But taking a very traditional view on asset management from a financial perspective, art is seen as unpredictable, illiquid, and quite frankly, just too much effort to get involved with. Like that's certainly the reaction I get. They don't see it as something that could be a seriously interesting part of a diversified portfolio. That's from a very traditional.
So that's interesting. So that's changing, right? So what we're finding is that when you're looking at let's look at the collector, right? So we, as you were saying at the beginning, we tend to deal with the institutions, and so in a way we're B2B2C, right? So the institutions deal with the end client. We end up dealing with the end client directly in most cases, and what we're finding is that collectors, the more sophisticated collectors. And sophisticated, I don't mean that in a pejorative way, but it's sophisticated, financially sophisticated collectors tend to want to see their art as part of their overall portfolio of wealth, right? And there's no reason why 5-10% of their overall asset value, which is often the case for high net worth, ultra high net worth individuals, that's a black hole, right? That shouldn't be the case. There's no reason for that when you see that actually you can resolve that through that combination of data and expertise. So that's what we do, right? Is that bridging that gap.
I just think that's a brilliant way of describing exactly why should that 5 to 10% have to be slightly chanced? Why can't it be managed and moderated to such a level? So you touched on how that's changing and how more sophisticated collectors, and I completely understand what you mean by that. Tell me about how that market and understanding has changed over the past sort of 6-7 years since you've been building the Overstone product. Like, was it quite a difficult sell to start with? How did that evolve?
Yes, yeah. Well, so yes, it's a very difficult sell, and it's a very long sell, right? Because when you decide to go into a B2B proposition, we've got major global banks and insurance underwriters. They don't make a decision overnight. We found that the relationship, for going from relationship to consideration of your service, on average, is taking us anywhere between, I would say, at the shortest, maybe 6 months, but at the longest, 5 years of nurturing a particular relationship and building that trust and building that comfort. Then when the bank or the insurers say, okay, yeah, great, we love what you do, let's go and do it. From that to actually the first or this assigned contract, we see another 12-18 months. So it takes a long time to get there, and yeah, so it's the beginning was tough because you're a relatively small organization and you're working with some of the world's biggest organizations, and so bridging that was quite difficult. But what we found is that the moment you start getting a few of these big whales on board, everyone tends to hear about it. Right. And and the risk department of one bank says, how come we're not doing that? Right. How come we're fingering in the air this particular part of our business? So it's once you start rolling, it becomes easier.
Was it a insurer that you were first, or what was it that you won for?
Bank, because I'm coming from that background, right? And so I understand the drivers. I speak the language. I know the people. I still have a pretty wide network in financial services. All of these guys, are like me, older, much older, and so. When they're still in the banks, they tend to be pretty senior, so that really helps in getting into that. And the insurance really started 3 years ago, in really focusing on the underwriters.
And presumably, it's opened up access for them to be able to do much more business in this space. Yeah. So, I mean, how has your business impacted banks, for instance, and their capacity to lend against art, and presumably that having you as that partner has allowed them to develop quite rapidly in this area in a way they weren't able to, or they didn't want to before, because they were also putting their fingers up in the air and taking the risk.
Yeah, huge. So if you look at, there's different types of clients. So you have the clients who are already lending, but realized that their balance sheets were getting so big that they had to find another way of monitoring risk, right? Because when a bank lends, they tend to look at a combination of the asset risk and the credit risk of the borrower, right? When you've got a fairly small balance sheet lent against art, you can really weigh heavily on the credit risk. But when it starts getting really big, you really need to look at that combination. And they didn't really have the tools to do that. And so now they're able to continue to grow their exposure into the market because they've got sophisticated tools that enable them to measure, monitor the risk profile of their collateral. So that's the ones who were already lending. Then you had people who were considering lending. So we've onboarded fairly recently a very substantial European private bank. They had never lent before. We spent a year with them in coaching them and consulting with them to help them get ready. And so most of those conversations were with the risk department of the bank, right? So working with them in making them comfortable about the asset class. And yeah, now starting to become a big player in the market. So that would not have happened had it not been for tools.
Yeah. So lastly, is there anyone else that does what you do at the moment? Either in the art market or perhaps in another asset market that's also considered to be very difficult to use data science in, to have to lower risk? And where might we be with it? Is it going to become something that people are much more comfortable with and everybody's lending against their art collections, or what do you think?
Yeah, I think so. I think I do not see any reasons for which art will not be considered an asset class, a leverageable. So if we look at the lending side, a leverageable asset class like cars, real estate, or any other similar asset classes. There's no reason, absolutely no reason. Once you have the tools to measure the risk, monitor the risk, there's absolutely no reason for that. Today the value, looking at the last Deloitte report, I think the value of art leveraged compared to the overall art in the hands of ultra high net worth individuals is roughly about 3%, 4%. 3% leverage. That is ridiculous, right? That makes no sense. So do I see a growth of that? Yeah, this has to be 10, 15, 20% of that art should be leveraged. So yeah, is this market going to grow? Yeah, I think it's got the opportunity to grow 10 times, 15, 20 times from where it is today. Sorry?
What percentage has it grown in the last 5-6 years?
It's hard to say because the data is not really reliable. I'd say it's probably grown by about 10% per annum.
Okay.
I'd say. Yeah.
Okay.
So yeah, and you just bring in new tools, you bring in a more sophisticated market. You probably saw what Sotheby's did with their bond launch a couple of months ago. They now were able to actually get a rating on a bond that was predominantly built on art secured loans, right? So that's a really transformational aspect of the market. The more you get these kinds of tools, credit default swaps, which are coming to the market, that market is going to continue to grow. And on the other side, what's very interesting when you look at the insurance piece, you see that there is actually not that many insurance underwriters that are specializing in art or that have a dedicated art insurance department. That's because of the lack of knowledge and lack of comfort with the asset class. But also, they don't really know what their concentration risks are, right? Am I overly exposed in California? Right? Or actually, am I underexposed in California? Can I actually increase my exposure to California? But I don't know that because I don't know the values, because I don't have the tools to do that. And so we're very excited about the future.